Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Christian Magoon, founder and CEO of Amplify ETFs. And we are talking about some very interesting areas of the market that have attracted investors this year, particularly amid ongoing market volatility. So we'll be talking about cybersecurity, income, and Bitcoin. Christian, welcome back. Great to have you with us today.
Hey, thanks, Neena. It's always great to be on the show and good to hear your voice.
Sure. So let's start with cybersecurity. And we know that our world is becoming more digital, more interconnected, and the frequency and severity of these cyber breaches and threats that continues to rise. And particularly now, companies are incorporating AI into their businesses. And at the same time, hackers are also using AI to amplify and intensify these cyber attacks. So in this scenario, tell us what kind of growth you expect in the global market for cybersecurity products and services?
Yeah, well, I think there's two ways to look at this. So cybercrime is very costly to the global economy. This year, it's expected to cost about $10.3 trillion, which is unbelievable. I mean, that would put cybercrime, if it was a country, in the top 5 of GDP. So very costly area. And that $10.3 trillion in 2025 is expected to grow to $15.6 trillion by 2029. So this is an area that has a huge liability or cost for all types of businesses, governments, and individuals. So it's definitely a key growth theme worldwide. In terms of the actual cybersecurity market, the marketplace in terms of services and solutions is expected to grow about 9.3% in 2025 to $203 billion. And it's forecasted to grow from that $203 billion to about $280 billion by 2029. And again, this market is primarily divided among solutions and services. So solutions could be equipment and various software. Solutions could be consulting, as well as some of the artificial intelligence applications that are being devised. So very robust area. If you believe in AI, if you believe in robotics, you believe in digitization, blockchain, cybersecurity goes hand in hand. So a very interesting theme, we think, to have exposure in a growth portfolio.
Yeah, those are some amazing growth estimates. And they make sense because we know that many companies, they are cutting their discretionary spending amid this rising economic uncertainty. But cybersecurity is an area they cannot afford to ignore. So they will not be cutting cybersecurity spending, that we know. And then governments around the world, they are also planning to increase spending in these areas. And are there any other tailwinds that you expect will be driving this sector?
Definitely the rise of AI is making cyber criminals more bold. So it's allowed them to scale their attacks and make them more sophisticated. And really at the same time, that's also pushing companies in the space to invest more in AI so that they can kind of try to get ahead of cyber criminals. So there's this race that's going on in the cybersecurity space to have not only the most powerful AI, but obviously access to power and machine learning to be able to, combat what is happening in that criminal side of the business. And that's probably going to push some more mergers and acquisitions. Cybercrime is global. It's becoming more sophisticated. And, to be a cutting edge company, you're going to have to invest heavily in that technology and be ahead of the curve. So that could be another growth driver of the segment. And that would be M&A activity and potentially some unusual M&A activity. It may not just be other cybersecurity companies buying existing vertical companies, but it could be some of the larger hyperscalers, for example, going out and securing a cybersecurity company and bringing them in internally as these hyperscalers are trying to deploy AI on a big scale, and everyone wants data privacy, data integrity, and what better way to have that than to acquire a company that's fully focused on your stack. So very interesting kind of environment going forward as demand rises for the best cybersecurity solutions and systems that are out there.
Right, talking about hyperscalers and M&A, we learned about a very big deal, very interesting deal earlier in March this year. So Google parent Alphabet, they announced a deal to acquire cybersecurity startup Wiz, and that was for $32 billion. So yeah, a big price tag, and you expect an increase in M&A activity in the space now, right?
Yeah, definitely. There'll be some groups that are acquiring just to build scale and to acquire maybe certain AI models or capabilities. And then there will be others that are just not in the space, but their business is going to be so dependent on data integrity and security that they want to take down an actual company, bring it internally, and have kind of the best operation they can be that's focused on their unique business application. So, yeah, this is going to be a very interesting trend to watch over the next few years.
So let's talk about your ETF, the HACK ETF. Very interesting ticker symbol HACK, easy to remember. And this was actually launched in 2014, and it was the first cybersecurity ETF, and then it was acquired by Amplify. So let's talk about this ETF and some of the cybersecurity stocks, some of the holdings in this ETF that you find really attractive. And I should add that this ETF is up more than 8% this year, whereas the NASDAQ 100 index, despite all those gyrations, it's almost flat for the year now.
That's right. So cybersecurity has been an alpha driver this year. We're now kind of flat in the NASDAQ 100. But, we just came out of a pretty steep drawdown. And during the drawdown, cybersecurity stocks held up better than the NASDAQ 100. Essentially, looking at the MEG 7, which kind of powers the NASDAQ 100 versus kind of a very unique, different group when you look at cybersecurity stocks. They have that unique blend of the long-term growth of this theme, but also the defensiveness, as you mentioned, because governments, corporations, individuals really view cybersecurity spending as a utility. It's necessary. You need to have it to run your business. In fact, even this year, the Trump administration came out and the chief information officer for the U.S. government actually sent out a memo to chief information officers of large companies saying that they expect them to continue to have high cybersecurity standards, as well as considering that when they look at the size of their organization. So there's a lot of pressure, not only in the U.S., but even the European Union has also sent some directives to corporations. So it's a very interesting growth / kind of defensive story. And as you said, we've seen some really nice alpha. In fact, going over, the fund has been out since 2014. Its 10-year annualized return is just over 10%. 10.11%. Its 5-year annualized return is just over 13%, 13.49. So pretty consistent area. And yes, HACK was the first ETF in the space in 2014. I actually was part of that, believe it or not, that launch initially. And when we launched that fund, the kind of impetus was that cybersecurity was going to be a theme you wanted to invest in, but it had no exposure in the technology spider ETF or even the NASDAQ 100. These companies, many of them weren't pure play, and it was just emerging. And if you remember, shortly after the launch of this product, which was the fall of 2014, the Sony cyber security incident happened, which really elevated cyber risks around the world. In fact, the Obama administration even implemented a variety of cybersecurity guidelines, and it was off to the races. So this fund went from zero in the fall of 2014 to really over $1 billion in 2015 in short order, and it's been kind of an essential area for investors to look at on the technology side. It's powered by a NASDAQ index that selects companies primarily based off revenue. So a company has to have 90% of their revenue from cybersecurity, which we think makes this the purest ETF in the space. Only about 23 names currently in the portfolio, so pretty concentrated. Last year, Hack had a really nice year. It outperformed all the cybersecurity ETFs by over 500 basis points and is having another strong year as well. So, when you look at the top holdings, if you're familiar with cybersecurity, you're going to see a lot of names that you recognize and that are in the news quite a bit. The portfolio is 76% large cap, so very kind of high quality large cap companies versus only about 23% in the SMID area. But these names are companies like Broadcom, Palo Alto, Zscaler, Okta, Cloudflare, Cisco, and really they kind of span the gamut from companies that are developing equipment that like routers and switchers that are highly secure, that are part of a company's network, to running cloud-based applications that are using artificial intelligence and machine learning to try to keep your computer and your systems up to speed, to even firms that deploy physical people into your organization to clean up after an attack and do the forensics. So it's really the whole value chain that kind of sits in this ETF, which is, again, 23 companies based on an index, and that index rebalances on a quarterly basis.
Yes, pretty interesting. And I do see that it is quite concentrated. So Broadcom accounts for almost 9.5% of the portfolio. And then we have Cisco and CrowdStrike at a little more than 6% each. And as you mentioned, the ETF has done quite well. So definitely worth a look. Now let's talk about another very interesting, very hot area of the market that is covered, called ETFs. And somehow investors love income in the current environment, and they have been piling into these ETFs that use options to deliver juicy dividends. And we have seen a surge in these launches, the launches of these products, particularly this year. It seems that every other ETF being launched uses options in some way or the other. So tell us, what is driving the popularity of these option income ETFs?
Yeah, it's really interesting to watch, right? So we launched one of the first option income ETFs back in 2016. It was when we first started out as a company, when we launched some of our first ETFs at Amplify 2016, and that was DIVO, DIVO, which is one of the top 3 or 4 ETFs now in terms of AUM in that category. And I think what's really driving it, Nina, are kind of multiple factors. The first one I would say is demographics. There's many investors that are moving from accumulation in their portfolio to distribution in their portfolio. And by that, I mean just trying to receive income, particularly monthly income, from their portfolio because they're retiring. And they're looking to their portfolio to help fund their retirement. And you look at how many baby boomers are retiring every single day. I think it's about 10,000 right now. That has been a big shift in kind of the demographics of investors. And certainly that group has a significant amount of wealth and is inheriting now a significant amount of wealth. Secondly, I think part of this kind of interest in option income ETFs is due to market conditions. There's something to be said when you have an ETF or a fund that has multiple sources of return. By that, I mean, does not just rely on price going up or price going down. When you have price appreciation plus a second source of return, which is option income, it really expands kind of how you can actually, gain in your overall investment. There are some ETFs like our DIVO ETF, which I'm sure we'll talk about, that has three sources of return: price return, option income return, and then dividend income return. So, we've been in a bit of a volatile market. We've been in somewhat of a sideways market as well over the last little bit. And, when price return really isn't there, to be able to benefit from increased volatility as an equity investor through options. And by that, I mean primarily writing covered calls. And then also potentially to have dividend income coming in, even when price appreciation isn't there or is negative, is either a nice source of return or really a offset against price depreciation. So I think that level of consistent monthly income that can offset price movement, particularly depreciation, is just attractive to investors. And you also have to probably say that many of these option income ETFs have been created to maximize income, but minimize capital appreciation. And I think that's one area that investors have to be careful with, not to just look at the equity option income ETFs that have the highest yields. Most of those products are going to give you the lowest capital appreciation. So we've seen some of these option income ETFs that have maybe 11 or 12% yields. And then you look at their total return over the course of a number of years, and their total return is only single digits, 4 or 5%. And we think investors really need to, for their long-term good of their portfolio, balance when they're looking at an ETF the current yield with the total return. If your current yield is much higher than your total return, that may not be the best long-term outcome for you as an investor. So we have a variety of products that kind of have kind of a balanced approach to generating monthly income, but also having upside in terms of capital appreciation. And we think that is the smart way to go after some of these yielding products, and more sustainable way to do that. So that'd be a little tip I'd provide to listeners.
You are right. Investors should always look at the total return. And in fact, I looked at the total return of your ETF and compared that with JEPI, which is the most popular product in this category. And because JEPI did quite well in 2022, and your ETF also did quite well in 2022 when, it was a terrible year for stocks as well as for bonds. So that is why these option income ETFs became so popular. And JEPI is now the largest actively managed ETF in the US. It has probably a little more than 40 billion in assets now. But when I look at the performance, since JEPI's inception, so it's been around for about 5 years. Yours has been around for even longer. So I saw that your ETF, DIVO, is up almost 90% with this 5-year period, whereas JEPI is up about 72%. But the S&P 500 index, of course, has done even better. That is up about 116% over the past 5 years. So we know that these ETFs, they offer high yields and they also help to reduce portfolio volatility. But at the same time, we know that there is no free lunch in investing. So these ETFs, they perform best in sideways market, but underperform during strong bull markets, and they also underperform over the long term. So who do you think is the ideal user of these products? Because generally we say that investors should just focus over the long term, and over the long term stocks generally go up, and by selling covered calls or using these strategies, you cap your upside to an extent. So in your view, who should use these covered call products?
It's a great question. And, fit is always a big deal when you're looking at all the different products, that are out there. And, I think investors that are looking for a smoother ride in their equity allocation may want to consider these option writing or covered call ETFs. So if an investor can stomach the volatility, owning the S&P or owning the NASDAQ 100 and riding its ups and downs over a period of time of 5 or 10 years is going to be the superior way in terms of total return. However, you and I both know there are, advisors and investors who can't handle 20-30% drawdowns and may actually push them to sell at the wrong time instead of being a buy and hold investor. And what products like DIVO do is smooth the ups and the downs, smooth the volatility. These option income strategies almost act as shock absorbers for your portfolio. So it works both ways, though, as you mentioned. You won't see the amount of participation in an S&P or NASDAQ 100 rally with these types of products on the upside, but you also will see, a nice cushion on the downside. And if that allows you to remain invested longer and really stops you from making, decisions at the wrong time to get out of the market at the lows, then it really benefits investors. So I would say, again, if you're looking for a complement to your existing core portfolio that would give you a little bit more shock absorbers, if you will, to market volatility, a product like DIVO is a great complement. Another, use for a product like DIVO would be looking at your traditional dividend ETF. And instead of just owning a dividend ETF that has two sources of return, capital appreciation and dividends, covered call ETF that has a dividend focus like DIVO gives you that third source of return and option income. So, when you have three sources of return, that's a little bit more stable as well. And it really minimizes some of that price appreciation impact on your portfolio. So, we're in an uncertain market environment. We've certainly seen a lot of volatility this year, and we're essentially sideways. That's an ideal environment for covered call ETFs. And, I encourage investors just to take a look at, the chart of the S&P. And if they can live through that type of scenario year to date, that's probably the best, core holding. But, compare that to how DIVO is done and, being down less, in the drawdowns and, currently right now outperforming the S&P by a little over 300 basis points. That's year to date. That's been a nice result as well. So, and for those who own JEPI, DIVO's outperformed JEPI 3 of the last 4 years, and we think it's a really unique alternative and complement to JEPI. Obviously, Amplify's name isn't as big as JP Morgan, and we don't have a bank or financial advisors that put money into our own ETFs, unlike JP Morgan. So we'd love to have people at least consider us relative to that product and others as a complement. And having a track record that goes back nearly 10 years now, there's a lot of data there that we think is compelling for investors to consider.
So DIVO has outperformed JEPI over the longer term, and it continues to outperform this year as well. And you mentioned 3 sources of returns. And so I understand that DIVO invests in a portfolio of high quality dividend paying stocks. So tell us a little bit about DIVO's methodology and what it holds, which has resulted in this outperformance.
Yeah, so DIVO is an actively managed ETF. It's managed by Capital Wealth Planning, whose chief investment officer and CEO is Kevin Simpson. Many people may recognize him as being part of CNBC's halftime report. And this is really kind of our flagship strategy along with CWP, where CWP is buying and selling companies on an active basis. And these companies are high quality blue chip. And how they define that is company has to have earnings growth and they have to grow their dividend as well. So it's a kind of a Dow Jones type universe that they're looking at. Then they have the ability with these dividend paying blue chip stocks to tactically write covered calls on the portfolio. And that tends to happen as volatility spikes or maybe you see large run-ups in individual securities. So, the portfolio oftentimes will be, around 25 to 30 names, and you may see 4 to 5 covered calls written in any given time on the underlying stocks. So unlike other products that maybe are entirely covered, meaning they cover the entire portfolio for a higher income, but then limit the upside of those companies, this is really a tactical portfolio. And that's why, Nina, you see some of the larger total return over time, closer to something like the S&P than some of the other products that maybe have a higher yield, that they constantly cover their portfolios and really limit the long-term capital appreciation. So this is, I think, very unique. The fund's over $4 billion. It's 5-star rated on the Morningstar rating system. And it's really become, I think, a compelling option for core portfolios, and then certainly an alternative or complement to existing dividend products. When it comes to yield, it's about a 4 3/4 yield. So it's not earth-shattering yield, right? Relative to some of these other higher yielding products. But, the real key is digging into the total return and seeing, for example, a 5-year annualized total return of 13.2%, which, relative to the S&P at 15.6 is, about 2.4% behind. But as you know, looking at other 5-year total returns for many covered call ETFs, some of them aren't even in the double digits. They're in the single digits. So we think, again, looking at total return is important. It's great to have above average income, which 4.76 is greater than the average dividend ETF and certainly the S&P. But we think the magic is in the long-term total return, which really benefits investors over the long run.
Talking about the distribution yields, I was also interested in your thoughts on these single stock covered call ETFs, which have like insanely high yields, sometimes even over 100% or 200%, because they write options on the most volatile stocks in the market. But the problem with those ETFs is because these stocks are so volatile, when you write options, you give up a lot of the upside, and you still you have to live with most of the losses. Whereas in case of ETFs like DIVO or even JEPI, the portfolio doesn't see outsized moves which normally stocks like Strategy or Coinbase see. So that is why their performance shortfall versus the underlying security or the underlying index may not be that striking. So what do you think about single stock covered call ETFs? How do they compare with broader ETFs like DIVO?
Yeah, I think they're quite interesting, right? And, most of these single stock ETFs are written on some of the most volatile stocks in the marketplace, the micro strategies now called Strategy or Coinbase or Palantir. And the yields are just eye-popping, right? I mean, 150% in some cases. And, I think the first, kind of consideration is, to own these covered single stock covered call ETFs, you really have to have a bullish view on the stock. Because you have 100% exposure to the downside of the price of the company. Now, if you are bullish on the stock, you might actually want to own the stock instead of the covered call version, because the covered call version is going to limit your upside. So this is like, you kind of want to be in not too bearish and not too bullish camp, instead be kind of in the middle, leaning towards bullish. And, essentially, these covered calls are, strategies are seeking to harvest as much current income from these stocks that are quite volatile, and in exchange giving up a certain amount of upside. So again, if you were very bullish on the company, you'd want to own just the individual company. If you are somewhat bullish on the company, but know that it kind of jumps around quite a bit, but has an overall trend up and to the right, maybe these covered call ETFs work. However, just be aware that you're taking considerable considerable risk. You have all the downside, as I mentioned before, of the stock price. You are focused, your investment is focused on a business which has its own unique business-specific risks, whether that's people or product or headline risk. In addition, you have a sector risk. So you're exposed to whatever is going on in that sector from an individual company standpoint. It's quite different than something like a DIVO or a JEPI that seeks to have a more diversified portfolio, have, multiple companies, 25 or more companies that have the fund provides exposure to across many different types of industries. So it diversifies your business risk, your sector risk. And in addition, most of these funds aren't seeking to, write covered calls that are maximizing income. They're trying to take more of a balanced approach to obtain a measure of income that would be attractive, but also balance that with long-term capital appreciation upside. So it's definitely two different types of products, but many individuals who are buying stocks, and maybe they're buying leveraged and inverse individual stock ETFs that seem to be gravitating towards these covered call products because of the high income. Unfortunately, I think there's others who aren't very familiar with how these work, see the yields, sometimes, like we said, over 100%, and really don't understand the risk they're exposing themselves to. And, eventually, and unfortunately, they may learn a hard lesson there. But they're certainly gaining in popularity. I think there is a use for them in portfolios. It's just being aware of the risks that you're taking and the exposure to kind of the different types of returns that factor into these products, which essentially are the price return of the underlying, whether that's 100% of the downside or capped upside, which again is offset in some way by the premium income you receive from covered calls. So I would say, maybe there's some unique instances to use this if you are more of an aggressive investor, but, be very careful if you're coming from the income side of investing and looking at these, because they are fairly high risk and offer a high volatility. That's why there's a lot of high income. There's no such thing as a free lunch. Please do your own due diligence and do a lot of research before kind of owning these products, because I think you'd be surprised at maybe how volatile they are if you aren't familiar with them.
Yeah, you made some great points over there. I totally agree with you. It is very important for investors to do their homework and learn about the risks involved with these products. Now, going back to DIVO, you also have a sister fund, which is IDVO, which invests in international stocks. And international stocks have been doing quite well this year. In fact, the MSCI Equi ex-US index is up almost 14% this year, and it is outperforming the S&P 500 index. And if that gap holds, then this would be the biggest annual outperformance since 1993. That is according to a recent Wall Street Journal article. So tell us about IDVO, and do you expect international stocks to continue their rally?
Yeah, so IDVO is really kind of the sister fund to DIVO. It takes that same approach of owning higher quality names outside the U.S. It has more names just because of the opportunity set, about 70 holding 68 to be exact, and essentially is looking for dividend paying companies. And then again, the manager, and in this case, there's two managers, CWP, as well as Seymour Asset Management. That's Tim Seymour, who I think many of us know from his time on Fast Money, who has a specialty in international markets. His nickname is the Ambassador on CNBC. So he helps to sub-advise with CWP on international markets. And yeah, this IDVO has been been a very fast-growing product for us. You mentioned international performance being very attractive this year. IDVO has a 13.75% return this year, which is quite good relative to the benchmark and outstanding relative to the S&P being flat. This is an area of the market that many investors kind of ignored for a lot of years, international stocks. And it's true, the S&P 500, the companies have about 50% of their revenue or sales coming from international markets. And many investors do have international exposure via owning the S&P 500. But we've seen this year that there is a difference on the domicile of these individual companies. And one just needs to look at the S&P 500 index versus the EFA index to see that difference. So we're hearing from investors, financial advisors, institutions that they're going back and reconsidering how they're getting international exposure and starting to look at dedicated international stock funds. And in our case, we're offering a product that, again, kind of provides that lower volatility when accessing international, not only through our selection process that CWP implements from an active managed standpoint by buying high quality companies that are growing earnings and dividends, but in addition, also having that ability to tactically write covered calls when there's opportunities to gather more income. So IDVO has a little bit higher distribution rate of about 6%. Relative to DIVO that we spoke of, that's 4 3/4, and certainly being an international this year has been a really nice alpha driver for the fund. So yeah, IDVO is a great addition to our DIVO suite. It's been around not nearly as long. We launched it. It'll be 3 years in September. So we kind of beat the rush to international markets, and I'll have our 3-year track record this September. And the fund continues to be one of our faster growing funds, just due to kind of the demand or the rediscovery, if you will, of international stock alpha.
Awesome. Now let's talk about your latest launches. And these ETFs combine two of the hottest trends, income and crypto. But again, going back to our discussion about volatile stocks or volatile assets, there are investors who are especially into Bitcoin because it is so volatile, and they love that high risk and high reward scenario, that kind of ride. So tell us about these two ETFs and the investment case, and who should use these ETFs.
Yeah, so I go back to almost 10 years ago when we launched some of our first products in 2016, and kind of pioneered, if you will, the equity covered call strategy category with DIVO. And we started to look at the emergence of Bitcoin, spot Bitcoin ETFs. We launched the first blockchain crypto ETF actively managed product back in 2018 in our block ETF, which is really kind of owning blockchain, blockchain stocks, crypto stocks, as well as Bitcoin through Bitcoin ETFs, et cetera. And actually Block has actually outperformed Bitcoin this year. But we've wanted to look at how do we maybe approach Bitcoin itself in a unique way. We tend to do things different at Amplify to set ourselves apart. We didn't want to have the 9th or 10th spot Bitcoin ETF. So we started to go back to our roots and DIVO and say, what if we put in, covered call overlay over Bitcoin? Bitcoin is excessively more volatile than blue chip companies, even more volatile than NASDAQ 100 companies. How do we create maybe a sensible or prudent covered call approach to Bitcoin? And, could that help smooth out the volatility of Bitcoin, as some investors want, some of the volatility, but maybe not all the volatility? And because of all that volatility, could we even target certain income levels within the product set? So We launched two products a little over a month ago. The Amplify Bitcoin 2% monthly option income ETF, BITY, BITY. So BITY essentially seeks to write option income at the rate of 2% a month on Bitcoin. So a 24% annualized option income target. And what that does essentially is give you still about 50% of the upside of Bitcoin plus 24% income. So you're fully exposed to the price of Bitcoin on the downside, just to be clear. But on the upside, you have a little over 50% more of, or 50% of the upside of Bitcoin, plus, again, this 24% option income. So what I would call it is basically a balanced approach, maybe a growth and income approach to Bitcoin, smoothing out some of Bitcoin's price volatility. Yeah, you're giving up some of the upside, but in turn, you're getting this 2% monthly option income payout. We looked at that and said, boy, we think that would be quite interesting. However, we know there's a whole other set of group of investors who are high income oriented and might like to have even less exposure to the upside of Bitcoin in exchange for a higher yield. So we launched our Bitcoin Max Income ETF, BAGY, BAGY. And what that seeks to do is target an income level of 30 to 60% a year, while still providing upside to the price of Bitcoin. But that upside is only about 5% per week in the price of Bitcoin, because essentially the majority of the portfolio has a covered call written on it, and it's 5% out of the money on a weekly basis. So on a weekly basis, you could still go up as much as 5% if Bitcoin price goes up, that amount. However, any amount on a weekly basis that it goes up over 5%, you wouldn't participate. So we think that combination of having some upside exposure on a weekly basis and a target yield of 30 to 60% makes a lot of sense. That target yield of 30 to 60 is so big. It's kind of like, that doesn't seem very specific. And, the reason we had to do that is when you write cover calls on the entire portfolio, and again, we're writing them on a weekly basis, it's hard to forecast the exact yield because that all is based off of the volatility of Bitcoin. And at times, Bitcoin has been extremely volatile, and we might even be able to be at the high end of that range. At other times, Bitcoin has kind of sat there and done nothing for a while, which we'd be at the lower end of that range. So we're about to pay our first distributions out, or declare our first distributions in BITY and BAGY next week, actually a week from today, which would be, I believe, May 30th. So keep an eye out for them. And again, we think these are ways for investors to participate in Bitcoin, but have two ways to have a little less price volatility. Maybe you can't stomach the 80% drawdowns that Bitcoin has had in the past, but you want some of that upside exposure. That's where BITY might come in as a product that's more of a balanced approach to Bitcoin. Maybe you want even less price exposure on the upside to Bitcoin, and for that you'd love to receive a higher monthly distribution yield from covered calls. That's where BAGY really comes in. So we see these as tools or complements to potentially existing Bitcoin exposure through products like maybe an IBIT, or maybe even individual investors who own Bitcoin but say, I'm trying to turn that Bitcoin into some type of monthly income without giving up all the upside of my Bitcoin. These are ETFs that could be a great complement, alternative. And BITY and BAGY, again, are the tickers, and we'll look forward to having our first distributions here at the end of May.
Interesting products. Congratulations on the launches, and also congratulations on all the success. We'll have to leave it there, Christian, but thank you so much for joining us today and for sharing your insights.
Thanks, Nina. Always appreciate speaking with you, and have a great rest of your summer.
That was Christian Magoon of Amplify ETFs. Let's recap some of the ETF tickers that we talked about. So the Cybersecurity ETF is HACK, easy to remember. And we talked about DIVO, the income ETF, option income ETF, the ticker symbol DIVO. We also mentioned JEPI, which is the largest product in the space, JEPI. And the international ETF is Amplify International Dividend Income ETF, IDVO. And then we discussed two of the newest products. So those are BITY and BAGY, BITY and BAGY. And if you want to invest in Bitcoin itself, then IBIT, the one by iShare, IBIT, is the best ETF and is worth a look. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.